All right, guys, so the market is down today. It's been wobbling back and forth. The NASDAQ is down about 0.4%. I think it was a little bit worse last night. It got to about 1% pre-market. The big news I was seeing was about Bitcoin. Now, I want to make note. It's not an attack on Bitcoin, what I'm about to say. Michael, the Winklevoss twins, said last week or 2 weeks ago when Bitcoin first went under 90,000, he said this would be the last time you ever see Bitcoin under 90,000. To me, what that says is the second it goes back over 90,000, it'll never be below 90 again. Well, it went back above 90,000 and then fell right back. Now it's at 84, 85,000. This is not an attack on Bitcoin. This is an attack on people trying to guess prices in the short run. It is impossible. It is absolutely impossible no matter what asset you're talking about. I don't want to hear it. I don't want people to, if you get it right a couple times, pure guess, pure luck. In the short run, stocks, everything is a voting machine. In the long run, it's a weighing machine. So that's just a comment about that whole thing. With that said, Michael Saylor of Strategy would borrow against his Bitcoin to buy more Bitcoin. That's very, very, very unsafe. This is what caused the 1928 Great Depression, 86% crash in the market. The reason being is when you borrow against an asset to buy more of that asset. Now, except for real estate, because it's not a lot of volatility, long-term trends, you care about, the long term more. But on a short-term trend, if the price falls precipitously and your collateral is Bitcoin, well, if it falls too much, the bank will say, hey, you need to give more money to us. We're going to force you to sell Bitcoin. That's the problem with that. When you borrow money to buy the exact same asset that's highly volatile, that's a very scary proposition. But Michael Saylor goes back and says, I'm not worried about this. This thing can still go up 40, 50% a year for the next 4 or 5 years because it's got limited supply. It's a new digital, technology, blah, 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 blah. All those things, all great and dandy. But at the end of the day, it's a very scary situation in which a guy like that is being considered one of the smartest men alive. So now, stock market GDP. We had a big week last week in the market. Markets went up, I think, pretty much every day. Ended the month really strong. That took us back to almost 130% stock market to GDP ratio. This is the ratio that Warren Buffett calls the single most reliable metric on stock market valuations at any given time. A lot of people argue that GDP doesn't matter because of blah, 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 because of all this money earned overseas. It's all a bunch of gibberish. It still matters and matters profusely. And if you don't think it matters, let's go to the 10-year PE. All that cares about is what profit did the companies make in the S&P. Doesn't matter where it was earned. It's 127% overvalued. It's back over 40. Guys, this is not to say go sell everything. Dalton, our in-house analyst, asked me this week, it was, Paul, I just have a hard time recommending to a young person to dollar cost average. I said to him, I had these high valuations. And I agree with that. It's hard, but this is about getting in the habit of always investing every single month, no matter what's going on in the market. It isn't about whether valuations high or low. Yes, valuations are very high, and trust me, it makes me nauseous to think people are investing at these high levels, dollar cost averaging. But the point is, if you guess right this time, what's going to happen next time? You're probably not going to guess right, and it's going to cost you money. That's the habit you want to be in. You want to be the habit of constantly buying every single month, no matter where the market is. That's the behavior we're trying to reward here, not the behavior of guessing right. Yes, valuations are very high, but they've been high for a long time. They've been high since pre-COVID. It's still these levels of valuation here, going back to 2020, even before COVID, were levels that the market usually never saw unless there was a major bear market to follow. And we didn't really see that. So it's all about the habits being formed that we need to focus on. Now, something that came up in the markets the other day, let me pull up an article here. Let me try to find an article here about Trump and transferring mortgages. So here's his idea. What's he calling it? Oh, portable mortgages. All right, we're going to go to the Communist News Network, CNN. The Trump administration is actively evaluating portable mortgages. What you need to know. Now, I'm going to say this. I like this idea. I don't think Trump should be the one doing it. I think banks should be doing it on their own to get more people to borrow from them. However, the reason I'm confused about this is, let me ask you a question. Let's say you buy a house for 400,000. You put 100,000 down, you owe 300. 5 years later, you owe 260. But you want to upgrade houses. Does the 260 does the rate in the mortgage of the 260 transfer to the new house, and then the extra balance is blended in? Or is it you have to start from scratch if you don't want to put the full down? So if you buy a $750,000 house, but you have a 260,000 mortgage, do you need to put the difference of $490,000 down? If so, not many people are going to be able to do that. Will it be a blend? Will the first 260 be at your low rate and the other 300 or whatever the down payment is, 330 go to the higher rate and it'd be a blend? I don't know. But let's see if they're talking about that. Just over half of homeowners with a mortgage have a rate below 4%. Wow, that's incredible. How do portable mortgages work? A portable mortgage allows a borrower to transfer their existing mortgage and mortgage rate to a new property instead of taking out a new loan. Here we go. Things get trickier if the new home is more expensive. If it costs 450, so there you go. They're saying you have to cover the extra. That's the difference. Now, guys, how many people are able to write that check? Some would, but very few would be able to write that check. And that's part of the problem with this mortgage idea. I love the mortgage idea. It makes sense. It's like, hey, listen, what does it matter where the collateral address is? And maybe they charge more upfront fees for it, or maybe there's a transfer fee or something like that. Because we have to still make it a good reason for the banks to do it. But at the end of the day, if you owe $250 on a house and you're buying a house for $750, you have to put that difference down. It's gonna be hard for a lot of people. Even people buying a $750,000 house will have a hard time coming up with $500,000 down. Yes, you'll be able to get some money from your existing sale of the property. Let's say you sell it for $550, you're left with $300. You still have to come up with $200,000 extra dollars. Maybe you can, but at the end of the day, it's like maybe it doesn't work. These are all part of the issues to think about. Now, still people are criticizing the 50-year mortgage. Stop criticizing it, guys. It's if I see one more person say, do you want to pay X amount of dollars in interest over 50 years, or would you rather pay less? That's not the question. The question is, can you beat the return over 50 years? Can you beat that return? That's the question. Some people, if you borrow at 6% over a 50-year period, you can beat that by investing in the stock market. Over a 10-year period, based on valuations today, probably not. Over a 30-year period, yeah, you probably can with dollar cost averaging. So when people talk about the full interest cost being the thing to look at, that is absolutely 100% not true. So stop listening to that. It's not about how much interest you're paying. It's about the difference between how much you can earn on that money if you have the discipline to invest that difference. That's the key. If you don't have the discipline, forget about it. If you have the discipline, you're going to end up much wealthier with a 50-year mortgage than a 30-year mortgage. The other question becomes, how many people are going to be in a house for 50 years? Well, the average person, I think, owns a home for 7 or 8 years. So people don't even stay in for 30 years. That's also not an issue. I've seen people say, well, who stays in their house for 50 years? I'm like, well, who keeps their mortgage for 30 years? No one does. Not many people do. Very few people you meet, they say, yeah, I've been in my house for 30 years and I paid it off. It's very rare. So these are things to think about. These are not, nothing, very few things are very black or white in the investing world. This is why investing is an art. But you have to look at it and say, well, what about the appeal of paying off your mortgage and sleeping at night? Great, more power to you. For me, the sleeping at night is based on my mortgage balance to my house value. That's what I care about. I just found out recently my house was worth a lot more than I thought. I was going to pay off my mortgage in 5 or 6 years. Not anymore. My home mortgage is like 30% of my house value. I don't care. In 5 or 6 years, it might be 25% or 20%. I don't care. Because to me, what matters is if I have to sell this house fast, even at a major discount, do I have to come to the table with money at closing? If the answer is no, I'm not selling it. I'm not paying it off. And my mortgage is only 4.25%. Now, a lot of people are saying, well, when we get back to 3%, maybe. I don't think so, but maybe we get back to 3%. But you got to remember that 3% mortgage we had was all-time lows by a lot. So don't bank on that. All right, let's see what's going on in terms of the biggest movers today. Let me pull up Everything Money's website. Top losers. 4.8% only. It was down 11% at one point. Strategy Inc. Look, today it was down to 155 at one point. Yeah, so it's rebounded quite a bit, even though Bitcoin is still down. Robinhood is down. Coinbase is down. Nick, are you happy, buddy? Are you happy Alibaba's up so much?
Yes,
He's
you
not
already know
answering.
it.
Well, there you go. And these are the biggest searches from our group of our people in our community: Apple, Adobe, Meta, Nvidia, and Target. Yeah, these are all okay. So what's going to happen this week? We don't have really a busy week with big names. We got Macy's on Wednesday. Today, nobody really that I can even see that I even recognize. What about Signet Jewelers, Akron's own Signet? Let's see here. Salesforce, big one tomorrow. I mean Wednesday, big one after the close. People are gonna be looking at that. I'm gonna look at Five Below too. How many people are going to the cheaper options? People have been a lot more stressed about money. Same with Dollar General on Thursday. Things to watch out for. Who else is on here? I don't really care about those. Yeah, so Salesforce, um, perfect. Ulta Beauty. Oh yeah, Ulta, company I have stock in. Remember, don't buy a stock just because I or somebody else on the internet does it. But I believe in their potential and how cheap. Let's actually look at Ulta. I want to show Ulta and people because a lot of people would criticize me for the Ulta thing. So I'm going to show you guys my logic. Oh shit, Ulta's up a lot. Damn, when did this happen? Oh well, that sucks. All right, we'll disregard that. Ulta's up a ton. I thought it was down a lot. Well, who knows if it's still a buy right now. Let's pull up our stock analyzer tool and see if I would. So guys, I want you to remember, I'm looking at it from price versus value. Here's our stock analyzer tool. Here are my revenue growth numbers for the next 10 years, 3, 4.5, and 6. Profit margin, 9.5, 10 and a quarter, 11, 15, 18, and 21 for the PE, 9% desired return. Stock's only at 550. So guys, you can see the difference between Ulta at 350 and 550. That's the way I want you to be. I don't want you to see the stock up and go, yeah. It's like I really thought to myself, like, oh crap, the stock is up a ton. That sucks. That's the way I want you to think. The stock at 350 is below the lowest value. The stock at 550 is between the mid and high. If the stock was 800, it'd be nosebleed. Same company, probably same future, different price. Fifth pillar of our principle driven investing. A great story at the wrong price is a bad investment. Guys, these pillars are really, these principles are really important for our principle driven investing. It's really important to understand these. And if you're interested in getting these, click the link below, download our 5 tenets of principle driven investing, keep them at your desk like I do. Whenever the market gets highly volatile, pull them out, remember what you're doing. There's 5 tenets to them. I give you the 5th and most important one. And there are 4 even better. There are 4 still good ones out there. Click the link below. We will send you the free sheet that goes through every single tenant. Thank you for your time.